Let's address that question with Pramod Gubbi, who's VP Institutional Equities at Ambit Capital, joins in with his perspective. We are calling for a strong October performance in the markets, Pramod. If not going past record highs, then at least, you know, from a month-to-date perspective, giving positive returns, because the underlying festive demand seems to be strong this time around, with an unusually earlier Diwali. Do you also reckon that to be the mood and sentiment on the street?
In fact, the other way around. Obviously, it's very tough to predict short-term performances of markets, but going by the sentiment turnaround, particularly in the last 30 days or so, institutional investors seem to have decisively turned negative as far as the fundamentals of the economy is concerned. And in fact, the translation of those fundamentals into earnings growth for Indian corporates also seems to be taken a beating in terms of expectations. So given that, particularly from the institutional investors side, I don't believe you will see significantly positive activity. However, I think particularly the local funds will continue to be surprised by the sort of flows we've seen in the last several months now, particularly in the last 2 months, which has accelerated. So that sort of dilemma will continue to play on the minds of some of the local fund managers, where it is quite apparent that the economy has slowed down, given the sort of macroeconomic indicators we've seen, whilst you are saddled with pretty strong inflows. So that's a tough job to do now.
Pramod, what explains this vibrancy in auto dispatch numbers, and especially for CVs? Leyland numbers have been decent. Tata Motors numbers I looked in the morning, they've not been bad. And CV historically has been considered to be the harbinger of economic growth.
Yeah, I think there are multiple factors. I mean, it has been surprising, no doubt. It is a positive surprise. We're trying to scratch our heads and trying to ascribe reasons to it. I think part of it is statistical. Part of it is an inventory build-up ahead of the festive season. We reckon, CV sales haven't been particularly smooth always. It tends to grow in bursts and spurts. To that extent, post-festive season, we expect sort of a slowdown or perhaps even a decline in CV sales growth. But having said that, I think there is some pockets of the economy which are seeing positive signs in terms of freight rates. That's translating into some of the larger fleet operators. Maybe a sign of the GST-related consolidation we are hoping for. Some of the larger fleet operators, expanding their fleet. We need to wait and watch to see how long these sort of numbers sustain to say that it is a result of the industrial cycle picking up. Based on everything else that we're seeing on the ground, that's unlikely to be the case. So far, we reckon it's more of a temporary phenomenon.
But is the opportunity perhaps in the underpriced on a relative basis with the two-wheeler names, you think, Pramod? So, Bajaj Auto and Hero MotoCorp stand to gain more than the other high-priced names?
Relatively better, I think so, given their relative underperformance. Valuations give you a certain margin of safety where there aren't too many expectations built into those stock prices. But having said that, I think they'll run into similar challenges, particularly in the rural economy, which they're largely exposed to, particularly on the commuter bike segment. May not be so much for a Bajaj, which is largely on the premium bikes, but maybe for a Hero and a TVS. You'll still need to deal with how the rural economy sort of comes out of the twin hits that is taken after demonetization in GST. But having said that, I tend to agree from a relative standpoint. I think valuations still allow a little bit of margin of safety to play that sector as compared to the rest of the auto sector.
Any reason why suddenly FIs have started selling 18,000, 19,000 crore is what we got in the month of August. I think the September data was also not very encouraging. Why suddenly the tide has turned? I mean, not that global markets have corrected or emerging markets downgrade have come in. I mean, every major global strategist is talking about great things for emerging markets, but selling in Indian stocks by FIs has only intensified.
I think it's a classic case of mean reversion here when the markets were going up, both from a market index performance standpoint as well as the currency standpoint. We perhaps outperforming the rest of the emerging markets back. And in the last couple of months, we've seen some sort of risk on building up, either because of geopolitical reasons or anticipation of the central banks unwinding their quantitative easing anytime soon, starting with the Fed. Both these augur not so well for the emerging markets in general. We've seen selling in the emerging markets in general. It's just that India has perhaps lost more than its fair share, just like it gained more than its fair share on the way up. And add to it, I guess, the local problems that have emerged in terms of lower than expected GDP growth, the negative news flow coming around GST implementation, and a possible expansion in fiscal deficit to stimulate the economy, which isn't playing well for the currency. So the currency again has its own effects on foreign institutional investors and their investment in the market. So all that seems to be adding up, and looks like there's no reason for that to stop unless there's a turnaround in the global markets.
Right. There was news this morning, Pramod, about DRL getting its key drug approval. Is the approach towards pharma more selective and IT more broad-based? It seems like things may have bottomed out for IT, so a lot of people are playing contrarian on IT as between the two, being a far more guaranteed bet, and of course pharma being more selective and stock specific.
Yeah, I would tend to agree. I don't think you'll get that much granularity in analyzing IT companies as much as you would get in pharma, because in pharma you can play based on exposure to certain geographies, the sort of drug pipeline, what sort of regulatory headwinds you've already been through or you're facing. IT, unfortunately, the sort of changes that are happening in the industry make pretty much analyzing granular details about who's investing in what areas a bit more difficult. So I would tend to agree with a more broad-based approach for IT and a case-to-case basis for pharma based on how they're positioned.
So do you think, Pramod, markets have peaked out for this calendar year?
Well, with the caveat that short-term predicting markets is tough based on what we see in terms of fundamentals and the sentiment that I talked about earlier in this discussion. I would tend to agree that the markets have peaked out, maybe not just for this calendar year, maybe for the fiscal year as well. It's important to see how the festive season pans out in the wake of the supply side of things still in a mode of disruption, and how quickly the supply side comes back, and that will drive how if at all we see any sort of earnings growth recovery in the next 2 quarters, and based on that there might be a possibility of another leg up given the sort of flows that we're seeing in the market. But as far as fundamental drivers are concerned, that will mean that foreigners will continue to remain sellers, and sooner or later, I guess, the retail flows will have to abate or perhaps even reverse.
Did you say fiscal, which means you are of the view that for next 6 months markets are not going anywhere?
That's right. So, I mean, given the fundamental that we're seeing, which is driving foreign investor sentiment. And like I said earlier, even local investors, some of them clearly seem to have raised concerns over the last 30 days. So except for the fact that these funds are getting a lot of inflows, there isn't much to pin your hopes of another leg of upside movement in the market over the next 6 months.
Okay, and Pramod, give us a sense on what are the events that could, be top of the market's mind, because we have, some bit of discontentment stepping in the markets with the growth numbers, which of course, takes a toll on the earnings outlook for the year as well, and how that settles in with pure market levels into the run-up of the second half of this financial year.
I think a couple of things. From a global perspective, I think we'll watch out for the Fed's action. They have indicated a beginning of the unwind sometime soon. I think that'll be keenly watched out, and how that translates into flows into emerging markets and other risk asset classes. Clearly, I mean, if there is an active unwind of the QE, you will see continued outflows from the EM asset class. Locally, I think this result season will be yet another interesting set of events to watch out for in terms of how corporates are seeing the whole GST implementation panning out, how their supply chains have adjusted to the new reality, and whether it is time for them to start investing in boosting demand yet, now that they've sorted the supply side out. So I think we'll have a busy October ahead, both in terms of global and local events to watch out for in terms of how both the global risk situation and the local fundamentals are panning out.